So if you look at the overall quantum of impaired assets in the system, as of March 15, it totaled to about 12.5%. If you even include the restructured book and the ARC receipts which the banks are carrying on their investment book. When you look at the quantum of loans which have debt service or an interest coverage ratio less than 1.5 times, it will be another 6 to 7% of the system loan. So our assessment is this 12-13% number could definitely creep up to something like 15-16 odd percent by FY16 or 17, and maybe then it will show some signs of stabilizing. So clearly a lot of these corporates are highly levered. That's our prime concern. In fact, in this context, I would like to point out a recent study which we did in terms of 30 large stress corporates, where we looked at particularly their entire debt on the banking system, totaling to about 25% of credit to the corporates. And most of these corporates had all the ratios fairly low in terms of interest coverage less than 1.5 times, debt to EBITDA more than 5 times, and even market cap to debt less than 20%. Our approach was, if you even look beyond the 525 scheme which the RBI is now talking about in terms of offering short term relief, cash flow relief, or even debt service coverage relief for these corporates, our idea was to look beyond that and figure out what could be the viability gap for these corporates, because many of them are sitting on such a huge pile of debt that even in an optimistic or a blue sky scenario where you can take their operating profits back to the peak capacity utilization levels, and even then the amount of debt reduction needed would be somewhere around 18 to 25% across these sectors. What it means is, in terms of the capital buffers which banks need to keep for any potential slippage from this, could be to the tune of 1.8 to 2.5% of their risk weighted assets. So this is one aspect as an agency we have been highlighting, and we have been also looking at bank rating incorporating this potential slippage when we look at the credit outlook. The key sectors which fall into this category are power, infrastructure, iron and steel, textile, sugar. So while on infrastructure clearly there are a lot of execution challenges, but again these sectors ultimately have a long gestation period and definitely an inherent value, and as the market picks up, as the sentiment picks up, some of them the recovery rates or the potential haircut could be lower. But the sector where we see some immediate concern is particularly iron and steel, where we think the debt is at a tipping point and capacity utilizations also don't have any immediate visibility of picking up. So we think that's a sector which could hit the banking sector's P&L fairly sooner than expected. The way India Ratings look at stress test, basically factor in asset quality into the credit profile for banks, is we look at a through cycle credit cost for all these sectors, basically your estimated loss coming from the probability of default and the final loss given default for each of these sectors. Now we apply these estimates to the static portfolio for every bank, and we compare that with their ability to take this credit cost shock either through their P&L, or in case P&L doesn't suffice, then they have to take it through their capital buffers. The interesting point is, if you look at purely the cyclical component of this risk, most of the banks barely make it as per the minimum mandated Basel III capital ratio. But if you add the risk from infrastructure exposure and also the concentration risk being the risk of slippage from the top 20 accounts which they have, when you add that to the picture, the situation becomes much grimmer, and I think a lot of public sector banks would fail the test in that scenario. Our assessment is credit costs might show signs of peaking in FY16, but the only caveat is that provision cover for a lot of these banks is still fairly low. It aggregates to about 48-49%. So even though your slippages might start plateauing from next fiscal onwards, the final credit cost might come down with a lag of a year or so. So we think well into FY17 would be basically the year to venture a guess on the credit costs starting to soften.